watch it later on. And I'm gonna mute it. So feel free to unmute yourself anytime. But I'm not gonna be able to see your windows. But if you have, if you want to type up the questions, that's fine. I don't have any particular format for this afternoon session. But first of all, for those of you I haven't met, my name is Frank Liu. I'm the other UC for this unit. You may have heard my voice from two of the lecture recordings. And I used to run this unit by myself since 2015. It's been like, I don't know, 7 years running the unit. But this year and last year, unfortunately, because I'm here, I'm in China, and I can't do the face-to-face lecturing. And so I pretty much just leave on the discussion forum. So if you use the discussion forums, you see my name a lot, right? I'm trying to answer your question, trying to help you. So I don't have any format today. This morning, I ran a similar session for another unit, FINA1221, derivatives market and pricing. So some of you may do that unit in the future, but the purpose was just to say, I don't know, I'm offering you two hours as a face-to-face consultation for 6 of you, and then some additional consultation hours online. And I will start with just asking a question. How would you guys like me to run this? Would you like me to, there are a few options, right? I guess people like multiple choice rather than an open-ended question. So we have a few choices. We can either go through each week and talk about the most important stuff of each week. Or if you have any questions to start with, we can start with questions, and then we can talk about what's relevant to that unit, and then move on to the next question you guys want to talk about. And yeah, so this is the time that I really want some input from you guys. What do you prefer? A, go through each week. B, start with a question that you guys want to say, I don't know that question. How about we explain that question? And I will explain that question, and then we'll talk about the relevant stuff in that week related to that question, right? Yeah, so we have one suggestion, which is one input. Let's start with week 6, because that's where the first example we come from. What do you guys think? What do you guys feel like? A. All right, sure.
What is A?
Lorenzo. Hello, Lorenzo. Hello, Lorenzo. Can we have some practice questions? I think what is A? A is we going through each week, and then we may stop by some questions. B is start with questions and then go through relevant lecture content. I guess because week by week, that's fine. So I can give you a quick overview. But I have to admit that I'm not 100% familiar with Daniel's lecture note, because I gave my lecture note to Daniel. Daniel then modified it, so there may be some weeks that look different. But I was just gonna go through it with you guys. Hey, so we have the mock exam before the final exam. So to Jing Qiu, Daniel actually had a mock exam in week 12. Is that right? So for those of you, have you watched the lecture recording for week 12? No. Okay. Did anyone actually attend week 12 lecture? I have, Lucas. Did Daniel actually go through a mock exam?
He gave us some practice questions to do for each of the chapters.
Yeah, well, that's pretty much it. I really want to show you guys what a final exam looks like because it's in my computer. I'm trying to hold it off. I'm not going to show you. I'm not going to show you, right? Because then that means we have to rewrite one. But my honest opinion is that final exam is actually a lot easier than mid-semester. Mid-semester is already not that difficult, right? But final exam, in my opinion, is a lot easier. It doesn't mean there is not going to be any difficult questions. It's just on average, distribution-wise, that on average, the questions are a lot easier. And
is it because we have more of an opportunity to show our knowledge?
Well, it's really because we are constrained by the format of the exam. So, for example, all you have is just MCQs and some short answers. And in short answer question, we're not able to get you to list the number of steps that you do because it's ridiculous to ask you to type up formulas, right? So let's say how you actually do it is that here's my formulas and to do all that. And so Jiaxing just asked, how should I study if I feel like I understand the concept, but I don't know how to actually apply those concepts to questions? That probably means that you don't understand the concept, but I would say, I mean, again, this is another very honest opinion. If you can do MFL tests independently yourself, and if you feel like you are 100% okay with it, then I'm saying you're going to be fine with the exam. I don't think the exam is going to be anything harder than an MFL test. In fact, some of the questions are going to be a lot easier than an MFL test. And the next question from Brian is, will the format of the final exam be the same as the midterm exam? Yes. So let me just quickly show you. Let me share my screen. So say your exam is right here, just one click away. In fact, I'm going to click it, but I'm going to click this, click the coverage. So here is your coverage, right? We have 20 MCQs, 20, that's not many, really, that's not many. 20 MCQs, 2 short answers. So there could be multiple parts to the short answer question, but they are really supposed to be just short answers. We don't expect to write an essay. 6 chapters related to that. So I don't know. So let's say if you are really constrained on your time, and let's say how would you better prepare to maximize your performance? Here's the breakdown, right? You have all this. So about 11% allocated to chapter 6, 14% to 7, 9% to 8, 19% to 9, 23.5% to 11, and 23.5% to 12. So it is that we have a bit more coverage to about overall 47% to the last 2 weeks, because they are, I mean, really, we spend the entire semester just to arrive at chapter 11 and 12. So we spent the last 9 chapters just to get the foundation ready for 11 and 12. So it is.
Excuse me, Frank.
Yes.
Why are we doing unit 10? Why is it only 6, 7, 8, 9, 11, and 12?
Because 10 in chapter 10 we examined the other approach to do the evaluating shares, and we're not that's not example, and I don't think Daniel talked about it.
Fair enough.
Yeah, so don't worry about chapter 10. Yeah, I mean, it's definitely not covered this year. I covered that last year, but it's not covered this year. You don't have to worry about it. Again, just a question before I move on. For the short answer question, that's in the chat box. You guys can all see it. For the short answer question, is a little hard for us to show the calculation for us doing online exam. Can we do it on paper and upload to LMS? We will make sure that you don't have to do that, right? So which means when we write exam questions, we're already taking into account that it's difficult for you to type up your equations and your formulas. So we don't expect you to write like lines of formulas. We don't. Probably you may want to include one formula if you want to, but you don't have to, right? You don't have to. Absolutely zero need. So yeah, you can think about it. It's just like it's more qualitative than quantitative, if that makes sense. So all right. So let's start with great. So let's start with chapter 6, and knowing is going to count for 11%, right? 11%. And let me use my version of like a slide, which I believe it won't be too much different. I don't think it's going to be too much different. But it shouldn't hurt if we just use that to oh, there we go. So that one was done in 2018, and in that year we had lecture 6, which chapter 6 as part of the mismatch exam, right? But only for that year. But for this year, that's part of the final exam. So in chapter 6, I mean, what is the purpose of learning chapter 6, evaluating that instrument? Is that in week 1, we talk about, we introduce about financial market, right? We talk about the role of managers, especially financial managers. In week 2, we talk about how do we gather information, right? Where do we get information? Accounting reports, right? You're gonna learn it from the income statement, balance sheet, and statement of cash flows to help you make up your mind about how liquid this company is, how profitable this company is. And that's what we do in the first 2 weeks. In week 3, week 4, and week 5, is all coming down to one equation. And that equation is present value equals to cash flow divided by 1 plus R. Let me share.
Can you write that down, please?
Yes, I will. And
it's this for, what's this premised on, for week 1, 3, and 5, is it?
yeah, I'm just going to quickly show you how we build up to week 6.
Yep.
All right. So weeks 3 to 5, what we're dealing with is just simple this formula. So in week 3, we'll learn about why do we have this equality. So why do we have present value equals to the discounted cash flow? So we establish that relationship. We show you why that's the case. You know, we in a normal market, and if we're pricing everything in dollar term, and if your preference doesn't matter, in this case, preference doesn't matter because we can buy and sell everything in dollars. Then that means that your preference towards a particular concert ticket no longer matters because you can sell it in the market and you can buy your favorite stuff if that turned out to be a higher amount. And then in week 4, we investigate the role of cash flows. So in week 4, what we learn about cash flow is that, let's say, how do you actually calculate present value if you have only one cash flow, right? One cash flow. And what if you have multiple cash flows? Such that we then going down to say, well, we have annuity, we have perpetuity, and then we have annuity will grow and perpetuity will grow, right? That's what we learn in week 4. Nothing really fancy, but that's what we learn. And such that you're able to calculate the present value if we can find a pattern for cash flows. And then in week 5, what we learn is this. It's the interest rate, right? How do we actually, well, how do you express the interest rate? We talk about interest rate in many contexts. For example, you can think about the interest rate as, you know, nominal interest rate, inflation rate, real interest rate. You can also think about the interest rate as the one, what do you call that? The EAR, effective annual rate, annual percentage rate, and periodic rate, right? APR, EAR, and periodic rate. Or inflation rate, nominal rate, and real. And guess what? We spent 3 weeks just on that one equation. So you can pretty much think about, okay, now having the tools, we established that we know how that why they equal, and then we know how to deal with multiple cash flows, and then we know how to deal with different interest rate. Then we move on, and then that really comes to what we learned in the second half of the unit, which is week 6, and week 7, and week 8, 9, and week 7, 6, 7, 8, 9, because 10 and 11 or something else. So 6 and 7, again, we're looking at this formula as 2 applications. Application 1, bond. Application 2, shares, equity. And the reason why we learn bond as the first application is because if you think about it, what kind of instrument, what kind of asset, what kind of the financial product that we learn in real life will give you multiple cash flows? Well, bonds. If you look back, bonds give you coupon payment every now and then it will pay you a face value at the end. Well, that fits the multiple cash flows scenario. And then the reason why we learn bond first is because bond is easier. Why? Because at the start, you predetermine all the future cash flows. At time 0, we predetermine all future cash flows. So which means at time 0, I already know what my cash flows are. That's like an easier scenario than my second application, right? So at time 0, I know what the future cash flows are, such that I know I just want to price it, right? So which means I just need to price it. So the pricing formula comes down to this coupon payment times 1 over u to maturity times 1 minus 1 plus y power to n plus face value divided by 1 plus y power to n, right? That's the formula that looks like an annuity plus a single cash flow, right?
Excuse me, Frank.
Yes.
I'm sorry, excuse me. The first one you got there, that's over one
U
plus
to maturity.
is it?
U to
With
maturity.
no power of, yeah? There's no power of in the first
There's
one,
no
yes?
power on, yes.
Thank you.
And
Cheers for that.
yeah, no worries. So, but the reason some students will find out, okay, a bond study is difficult. That's because, well, where is the interest rate? So in this case, we don't actually have an interest rate per se. The interest rate was known as, so in practice, this is what is known as interest. The coupon payment is known as the interest, because if you hold on to the bond, just like if I make a deposit to the bank will give me interest, right? And if you buy a bond, the company will pay you interest as a coupon payment. It was just give you, the reason why it's called coupon, because back then we have to rip it off from the actual coupon bond, mail it to the company receive it, mail the payment back, mail a check back to you, right? That's why we call coupon payment bond, right? They look like an interest payment, but we know that this is not an actual interest rate, right? So the reason why they're not an actual interest rate is because price fluctuate. Let me use another one, because this one fluctuate, go up and go down or stay flat. So which means that the interest, that discount, the face value, does not necessarily give you the price. So in this case, we invent a new concept. We invent this. So we invent the concept of U to maturity such that this equality holds. Which means U to maturity is an interest rate that makes the right-hand side equal to the left-hand side. Make the right-hand side equal to the left-hand side. Because in practice, in real life, we observe this. We know what P is. We know what coupon payment is. We know the time to maturity. We know the face value. And we don't know what the interest rate is. But the interest rate is embedded in this formula such that the price would equal to the present value of my coupon payment using the U to maturity as an interest rate, right? So that's an important concept introduced in that week. And so quite often, what can be asked regarding coupon payment, like paying bond, is to think of it, well, how many variables, how many unknown variables do we have? So we have P, coupon payment, U to maturity, number of periods, and face value, right? And that means the questions related to it would only involve giving you 4 of them. Find the fifth, right? So which means in this case, this formula looks like I'm given coupon payment, I'm given U to maturity, I'm given the number of periods remaining, 10, 12, 18, whatever, face value, $1,000, $1 million, and I just need to find the fifth one, right? So you can think they'll come down to, well, I will be given 4 and need to find 5. So which means on your MFL test, in your tutorial questions, you're seeing a variation of that kind of questions that some of you ask to calculate price, some of you ask to calculate the coupon payment, some of you calculate the number of periods away, some of you ask you to calculate the U to maturity. I don't think anyone would ask to calculate face value because by default it's 1,000, right? But that's what likely could happen. But that all comes down to think about this is just an application of this formula of what we learned in weeks 3, 4, and 5. This is just an application of that, right? Oh, there's something come up in the chat box. Let me take a look. So is the coupon payment always the same no matter how P changes? Is that yes? So to Nick, if you want to read Nick's question, Nick was saying, so is the coupon amount always the same no matter how P changes? It's just the U to maturity that changes with P. That is correct. coupon payment is fixed. Face value is fixed. Time to maturity is predetermined, but it will decrease because we're getting closer. And this is why. Oh, actually, I'm trying to move my iPad. This is why bond study. Let me use yet a different color again. Bond study is called fixed income securities. The reason why it's called fixed income securities is because your income is fixed. So which means at the time that you purchased it, you already know what kind of income you get, right? So which is very different from our second application. We haven't got to that part yet. And what was then introduced in that week is that there is an inverse relationship between yield to maturity and price. Inverse relationship between those two, right? Because your payment is fixed. The higher the discount rate, the lower the price. The higher the price, the lower the yield to maturity, right? Inverse relationship between that one and that one. Between that one and that one. And everything else in practice is already given. You can never change the coupon payment. I don't think the company will be able to say. If they say they want to change the coupon payment, that means they partially defaulted. Let's say, oh, well, originally I guaranteed to pay you 5%, but I can't. I pay you 3%. That's a partial default, right? It means I can't actually pay you back. So then that comes down to credit risk.
Hold on, Frank.
Yeah.
That green, what you wrote in green in the formula, what was that again?
This one?
Yeah.
Fixed income securities. So people call that bond as fixed income securities. Fixed income means your income, once you hold it, it's going to be fixed, right? Because that's in contrast to the other. Right? And because of that, people think that bonds are very boring, and which means that there are no challenges of studying that. I mean, it is true. The trading in bonds are so much less liquid than equity. Well, part of the reason is because it's quite boring, right? There's not going to be any surprise. I mean, if you go to the discussion forum, someone actually asked the question saying, how do we actually profit from holding a bond, right? Someone asked that question. It's a fair question because it's like, once you know your income, how do you actually make a profit? Well, just remember, receiving coupon payment is an income. That's first of all. And second of all, there could be factors influencing people's belief on the likelihood of the company default. And I know it's the tongue twisting. Let me say it again. There will be factors influencing people's perceptions about the likelihood of the firm to default, which means that the firm may not default, but there are some events that make you think that the firm may default. Because after all, what determines the bond price? What determines the bond price is not this formula. This formula does not determine the bond price, right? Even though that's what you're told, but this formula does not determine the bond price. Let me just write here. This formula does not determine the bond price, right? What determines the bond price is demand and supply. Demand and supply in the market tells you what the bond price is. And then from that bond, and then why is this formula useful? Because this bond price formula tells you if bond price is X, what would be the corresponding Y, yield to maturity that people think, right? And then you can then link that to your own yield to maturity. Well, if they're paying $1,000 for that, their yield to maturity is 4%, but my yield to maturity is 5%. That means I'm not going to buy this bond because I require 5%, but this one only provide 4%, right? And that's the whole purpose. So just bear in mind, this formula does not give you the bond price. Bond price is determined by demand and supply, right? Demand and supply. But nevertheless, it's important for you to learn this because then it tells you what the yield to maturity is, right? And that's just one example of leveraging on what's available in the market to estimate what people think about the interest rate should be, right? And because firm can default, we talk about credit risk, we talk about, and then talk about credit risk like AAA and AA and so on and so on. And credit risk is related to chance of default. You can think about the chance of default. If they are completely zero chance of default, then that's it. We don't have to learn anything beyond that. But because in real life, there are chances for some company to default. So which means we need to take care of that, right? And that means the higher the credit rating, the lower the chance for them to default based on what that company thinks, based on what S&P thinks. But does that mean it's going to be 100% accurate in prediction? We don't know. Well, it's someone's opinion, right? That's just that organization's opinion based on what they learned from this company. They think that company has a very small chance to default. And then you have like junk bonds, this level, and this is like good quality bonds. And this is where like a lot of trading. A lot of trading in the junk bond back in 1980s. That's because there are a lot of mispricing. The reason why here there are a lot of mispricing in the junk bond is that as you move down the range in credit risk, the discount rate gets higher, right? The discount rate gets higher. And once the discount rate gets higher, that means there's a higher chance for you to get it wrong, right? Because what if, so let's say that pay will tell you the discount rate is 4%. But what if it's actually 13.5%? So, but comparing to, if you think the default rate, the discount rate is 4%, well, in this case, 4% is for like, there's not going to be any deviation from that 4%. But as you get rated higher, there's a higher chance to get it wrong, right? And that's what a lot of mispricing is. And that's what a lot of trading is, right? A lot of trading. And the other relevant concept with that is credit spread. So know how to calculate credit spread. So that's covering your lecture note. Go to that lecture and talk about credit spread, right? But that's pretty much it for week 6.
Excuse me, Frank.
Yes.
What about zero coupon bonds? What is their main purpose?
Well, their main purpose is just like the easiest example of that formula. So because zero coupon bond just means there's only one cash flow. So which means your formula is just like this. Right? That's how we're moving from something that is harder, easier to something that is harder, right? So this is coupon paying bond. This is zero coupon bond.
Where would one get a zero coupon bond? Where would one purchase such a security like that? Where
I mean, government sells their treasury bills as a zero coupon because they don't pay you any coupon. So basically, they sell you at a discount. So which means that you will receive, you will receive $1 million in 3 months' time, but you only need to pay I don't know 987.
Exactly. Yeah. And that the spread being the difference is what you'll get in the 3 months' time or year time.
Correct.
It may be. Yeah. Okay.
Correct. And then I think last year, probably not apply this year, or 2 years ago last year. I mean, Warren Buffett is the king of the treasury bills because he holds so many treasury bills that he has even more treasury bills than the government. And that makes his borrowing really cheap, right?
Indeed, because but the average Joe Blow, because the yield on bonds is very minimal, very conservative. Where Buffett's got the convenience, he's buying tens of millions all at one time. The average real world person,
exactly,
can only afford $10,000. You know what I mean? So it's all relative at the end of the day, isn't it? It's just
That's right. So he became the person to go to if you have to buy something. Because after all, when we say don't put your money in your pocket in finance, right? To say don't leave your money in the pocket, you should put it in the bank. We don't actually mean you put it in the bank because bank may actually default, right? In Australia, the APRA only covers your savings loss up to $250,000. So which means if you have a savings account about $250,000, they can cover all the loss up to that point. But if you have a savings account of 500 grand, they only cover up to $250,000 loss, right? That's it. I mean, the government's not gonna be able to help you beyond that point. But anyway, so when we say don't put your money in a pocket, it just means that sometimes you need to buy the government bills just to cover such that your money is invested somewhere, right? Not living just below your pillow, right? So that's pretty much it for week 6. That's the first application. Now let's move on to the second application, equity. So the reason why we learn equity as a second application is because equity is a lot harder than bond. Equity. Well, because first of all, we don't know what the future cash flows. We don't know, right? And that's it. We don't even know. Like, I mean, there isn't any second point. But you know, so let's say if you're buying a share, right? I don't actually know the likelihood of the company paying dividends. They may pay dividend. They may or may not pay dividends. I don't know, right? And whether they're gonna hold on to a fixed cap dividends or are they gonna pay, you know, like an increasing amount of dividend, I don't know any of the answer. But the reason why I choose that as an application is because it is reasonable to argue that as a shareholder, again, reasonable to argue that as a shareholder, your future income is comprised of dividends plus selling off the share. That's not unreasonable because that's if the shareholder, you will be entitled to dividends, but they may not pay, but you are entitled to dividends. And then when you sell the shares, you get a share price back. So which means that in this case, we start with something that is very, very basic, which is this dividend discount model. As always, if you see a name modeling, that means it's not accurate, right? It means we need assumptions. So here the assumptions are. Thank you very much. Thank you. Got my coffee delivery. Perfect. Time for coffee. So here now we need to make a lot of assumptions. The first assumption is that how often do they pay dividends? And if they do pay dividends, what amount of dividend do they pay? Do they pay a fixed amount? Do they pay an increasing amount? Do they pay a decreasing amount? Right? So in that week 7, you see that we start with saying, okay, the company will pay dividends, and dividends gonna be a fixed amount, and they're gonna pay dividends forever. So unlike coupon payment, where there's a fixed period, which means you have a 10-year coupon paying bond, 20-year coupon paying bond, in equity market, in equities, you can't assume the company would only gonna go 20 years, right? That's unreasonable because they're supposed to live forever. They're independent legal entity, right? So which means that there isn't a life limit for a company. So which means that in this case, we're dealing with something that goes on forever. And that means our first model is price equals dividend divided by RE minus G. Why that's the first model? Because it's easy, right? We assume they pay dividend, and we assume that they pay a fixed amount, which means it's the same amount, and that is forever, right? And is that reasonable assumption to be made? I don't know whether that how reasonable it is. I've never seen a company that always pay the same amount of dividends. Always, I've never encountered a company like that. Maybe if you live long enough, you will. Maybe one day you'll come across one. But I don't think that is the case. But nevertheless, it helped us to develop some understanding regarding what determines the company price. So remember, we're learning all this model over here, not to help you price the actual company shares. That would be insane, right? This is only year 1 unit, right? We're not going to expect you to go out to say, I can price Apple now, right? That'd be stupid to say. But what we're trying to say over here is that from this model, we're able to offer you some insight about what determines share price. Let's move on to lecture notes now. Oh, we're already up to week 7. So again, don't freak out if you see that the lecture note looks different from Daniel's, because again, I believe he has made some modification based on mine, but the principle will be the same, right? I don't think they're going to be hugely different. So see how we have a dividend discount model. So this just summarized. We think the price is comprised of a series of discounted dividends. And then we simplify to say, how about we just saying that pay the same dividends and forever? Or they may, sorry, this is actually fixed dividend with fixed rate, sorry. Fixed dividend with fixed growth rate, right? Fixed dividend with fixed growth rate, that's how you get R minus G. Otherwise, we'll just divide by R. But what that tells us is this. So maybe Daniel already emphasized that, but I want to emphasize that again. So what's contained in those slides, it tells you when should firm pay dividends? And in what way would paying out dividend actually reduce your share price? Right? Because let's say investor may like the dividend, then why do you see a share price decrease if they pay dividends? Right? Because I mean, in real life, in practice, as a young company, do they pay dividends? Young company, do they pay dividends? No. Why do you think they're not paying dividends? Apart from they don't have money. But why do you think they're not paying dividends?
They're using
Research
to invest back into the firm.
Yes, and why?
Research and development, R&D. Yeah.
Yes, but why? But then what's behind that?
So that they can pay higher dividends in the long run.
Exactly. It's because, well, think about this. The reason why you give your money to someone else, I mean, let's just say, Lucas, let's just say, if you trust me, I'm like the Chinese Warren Buffett, right? I can give you 20% return every year, and then you will give me your money. So let's say you give me your Super Annie account, I help you manage that. And the reason why we do that is because you think I can invest better than you, right? It's not because you think that I'm actually Warren Buffett, but it's because you have a strong belief that I can manage your money better, such that I can generate higher return than you do it by yourself. And that's why you put your money in the company, right? It's because you think the company management are able to turn whatever that you have into a bigger pool of money, generate higher return, right? And the reason why established companies like Telstra, the reason why Telstra paying out dividends, why do you think they pay out dividends?
Because there's no possible way that they'll be able to grow as big anymore.
Exactly.
Like minimal growth, if anything.
Exactly. I mean, 4G towers probably are everywhere, and they are unlikely to build as many 5G towers around. So they figure like, oh, the market is pretty saturated. I don't know how to find out more high growth opportunities. In this case, if I cannot find high growth opportunities, I will then pay back dividends to you, so you can manage your money, right? So I mean, that's what we observe, right? That's what we observe as an empirical fact, right? Young companies don't pay out dividends because they are in a high growth stage. Older and established companies pay out dividends because they are established, mature. And how can we build a model to reflect that? So remember, again, we are not actually teaching you a formula to price shares. That's insane. What we're doing here is that we give you a model to help you realize this model can generate all these implications empirically, right? So for example, over here, firms has earnings, profit coming from them. They can then distribute whether they're going to keep it and whether they're going to pay back to the shareholders. So in this case, what he's doing over here is that is a symbol of growth. Is to think about in what way would that actually grow the company's shares. So in this case, what that whole derivation, again, it's not a lecture, right? But if you can go back and read that yourself. But what that tells you over here is that if you can find higher growth opportunities, if your ROE is bigger than RE, then you should cut down the dividends. That will grow your company, right? And otherwise, do the opposite. So that's all coming from a very, very simple model from justice. That's coming from a very simple model equation. That equation gives you some insight about their dividend distribution decision. All right, let me check the chat box. I've got one for growth. Yeah, for growth. Yeah.
I've just drawn a graph that I think might explain it.
All right.
I don't know. Would that be it?
Let me take a look. Sorry. Let me figure out a way to share a screen. I mean, to check your screen. Can everyone see it? Grow. Yeah. I think that looks like it. It's definitely not necessarily a straight line. And I mean, I can't really see the small handwriting on that, Lorenzo. But I think you get the idea. Is that this one tells you the decision behind whether the firm should keep it or should distribute it, right? So it gives you some implications of that. And let me minimize that again. All right. So, and you can think about, okay, well, there are a lot of questions can be asked regarding this week. For example, how would you use it, right? So, but I would say there won't be many questions that are harder than your MFL test, if that's the hint I can give you, right? Just so basically you should know what the lecture is about, and why that's the case. Yeah, sorry.
Would you recommend setting up an Excel spreadsheet with all the formulas necessary for this?
If you find out work for you, then please well do, right? Because we never officially teach you Excel in class. Maybe Daniel did partially, fractionally, right? But yeah, but if that works for you, if you figure out, if you find out, okay, I already know this concept by heart and I have already written my own template, then by all means use your own Excel template, right? But but again, the question really can be computed just using your calculator and your pen and paper, right? What question? What is the 2 or 3 stage DDM, dividend discount model? What does that mean? 3 stage discount.
Maybe the companies, they pay the dividend not in a constant rate. Maybe in the early stage they pay a very high, and then
oh yeah, thank you. Yeah, I mean that makes sense. So let me share my screen again. So student Jing Chiu was asking, can you elaborate on the 2 or 3 stages dividend discount model? So what she was saying here is that, again, remember we are dealing with an application of this formula, right? We are dealing with an application, and this is another slightly more difficult application. So what we have here is this 0, 1, 2. Sorry, 2.
Sorry, can you share your iPad?
Can you guys not see it? Oh,
I can't
can you not see it?
No.
No, I can't. No.
All right, let me try to. Can you see it now? No.
Nope.
Let me do another share. You guys can see, right? Okay. Let me stop share and then share again. Trying to load. Sorry. Can you see it now?
Oh, yeah, we're all good now.
Yep. Thank you.
All right, perfect. So let's say here, remember, we are still dealing within the framework of an application for this formula, right? This is the formula that we're familiar with, right? This is just another, application. So let's say over here, let's say if some company paying out high amount of dividends, and then they're gonna start paying lower dividend or constant rate, it's really just a cash flow question, right? So for example, if they pay D1, D2, and D3, and D4, and D5, where from D5 onwards, D6 equals D5 times 1 plus G. So which means from this point onwards, that becomes a perpetuity, right? Then really, I mean, the principle behind is that the price is just this. Sorry, there's no R1. We just assume the interest rate is the same. Sorry. I mean, the idea behind is same as that, except now we have to rely on knowing this part is a perpetuity with constant growth, right? So that means we can rewrite that part to.
Why is it now a perpetuity, please, Frank? After 5 years, why is that? From the
because the
cash
question
flow onwards, why?
Yeah, because the question may give you that. I mean, because after all, after all, what we're doing here is that this one is slightly more realistic, slightly more realistic. That's because, let's say we know this company well. I can actually forecast the actual dollar amount of dividends, or I can forecast the growth in the earnings every year. I mean, which is not unreasonable, because let's say if I'm a stock analyst, if I know the stock really well, I would say, well, in year one, which is going to be 5% more than last year. Year two, they're going to introduce the new iPhone 13. It's going to be 10% growth in that year. In year three, it's going to be 10% again. But from year 4 onwards, I think it's going to be growing at 2% steadily, right? So again, it's just trying to say, how can I make my seemingly naive model to be slightly more realistic, right? So which means that, okay, in year one, D1 is going to be $5. Year two, D2 is going to be $10. Year three, D3 is going to be 5, and D4 is going to be 7, whatever, right? And then after that, because I don't actually know anything beyond that. So, but instead of just saying they don't gonna pay any dividends, because that's stupid, right? Instead of saying that, I say, oh, I think from that point onward, the business will become mature and your customers are gonna be, they have a very steady customer group. I think they're gonna have a fixed earning growth of 3%. So from that point onwards, dividends are gonna be growing at 3% as well, right? And there's not gonna be any change to dividend payout ratio and blah, blah, blah. So that you recognize that eventually that become a perpetuity. Eventually that becomes a perpetuity, right? So in this particular example, that would just gonna be D5 divided by R minus G times 1 over R power to 4. In this particular example, right? But again, this is just an arbitrary example I came up just to show to Jing Qiu that if we try to bring more realistic assumption to say, I know something about year one, I know something about year 2, 3, and 4, and year 5 onwards, I'm just gonna make assumption. Then how do I price it? Well, that's just like this kind of cash flow. Nothing really more fancy than that. Did that answer your question, Jing Qiu?
Yes, perfect. Thank you.
All right, good. So in one of the MFL tests, I believe that's I actually don't know which one. Let me take a quick look. Sorry. So in one of your MFL questions, so in MFL 7, there's one that tells you the earnings per share, and then you don't pay any dividends in year 1 and 2, and then you pay dividend year 3 and 4, and then from year 5 onwards, you're paying like a fixed amount. I mean, a lot of students get mistaken in that one, and then Daniel even made a mistake in his own lecture exam, which is kind of my surprise. So. But anyway, but you can see that the idea behind is really just an application of discounted cash flows, right? Discounted cash flows. Now you just have a few more assumptions saying, okay, I know that dividend coming from earnings, whatever is not payout, sorry, whatever is retained will be pay out. That's how I calculate my D1, right? And then D1 comes from EPS. D2 comes from EPS 2. D3 comes from EPS 3. And so on, right? It looks tedious, but it's actually it's very simple once you know it.
Can you please share this particular solution to us?
All right, cool. I mean, I can put it. Let me figure out how I can. But yeah, but if I can put it. Last year I had an optional assignment in this unit because we didn't have mismatch exam, and this was one of the optional assignment question that I have, which is this year, which is your MFL test this year. Yeah, but I can share that to you. But just speaking of sharing, because I don't have numbers for this question, so you just have to guess. You just have to believe that's what I have, right? Anyway, so
we'll be getting this question, will we, in the end of year, end of semester
final exam?
Yeah.
I don't actually know whether that's gonna come out. I mean, I can check. I can check the final exam.
Yeah. Okay. Think about it.
Right? I mean, I was gonna check my final exam, but the short answer is I'm not sure. I forgot. We rolled that exam paper about 2 weeks ago, right? So I'm actually not sure. All right, so sharing my thing again. Screen sharing.
Sorry, what's the difficult level for the final exam? More difficult than the midterm exam?
And it will be cheap. It will be easier. Sorry.
But if we encounter questions just like the previous one, I think it's very difficult. And it's very
I wanted to say it's guaranteed to be easier, but I can't guarantee anything because I don't know your understanding of the unit. But the reason why I would say easier the reasons are twofold. First of all, you have less questions. You have less questions and more time. Right, that's the first of them. Second of all, that we're not going to ask you any difficult questions. I mean, I just have to confess, it's not going to be any difficult exam. But hopefully, there won't be difficult questions. So there will be at least 1 or 2 difficult questions. And if that happened to come up as your first question, don't freak out. That could just be the only one. Because we can't really control the orders, right? Because that varies for everyone. And I do feel bad because when we were marking the mismatch exam papers, we have a student who had the short answers to the first 3 questions, and then followed by those questions that you have interest rate expressed in different intervals, because we did write a few difficult questions. They all come out as the first 5 questions. So that really destroy you. I say that would really destroy you if that was your first 5 questions. But yeah, so I mean, we really have taken consideration of this.
But there's nothing in there to trick us, is there?
Well,
yeah, there probably is actually.
I don't know. There probably is 1 or 2 that I wouldn't say difficult. There would be questions that require you to think, right? But in overall, it's actually a lot easier in overall. I mean, that happened to be always the case. It's not like we did it special for you guys this year. Is that we always wrote a harder mismatch exam paper than final exam, right? Because after all, we want you to pass. As much as we love you, we don't want to see you in the same unit, right? I just, because I don't know about that, Daniel. I only have a certain number of jokes to tell, right? So I don't want you to hear the same jokes from me again next year. But before we move on to chapter 8, I've got a question from a student. If a company takes in more shares, do they count the additional dividends separately, or do they count in dividends in a whole lump sum amount? Well, the answer to that question, if you guys check the chat box, you can read the question yourself. But the answer to that question is that companies don't pay dividend per share; they pay dividends. You divide the number of shares, you get dividend per share. So which means that if they somehow there will be, let's say in real life, let's say if some instrument are converted such that suddenly the companies have more shares outstanding, then that means that the dividends each one person which will receive will be smaller, because the company is preparing to say, we're going to pay a total of, I don't know, $25 million out as dividends. You divide that number by number of shares, you get how many dividends that you will receive, right? That's how they make up their mind. Because after all, when they receive earnings, when they calculate the earnings in your income statement, they don't actually think of its earnings per share, because you see that in your bank account. I have $60 million as profit, can distribute, right? Then I will distribute maybe $20 million out to shareholders. And that work out to be maybe 5 cents to you on your case, depending on how many shares they have. Does that answer your question, Jiaxing? I mean, hopefully, okay, good. And oh, the other one is that share repurchase. So in this case, what we learned is that it's total payout model. So again, the formula is very straightforward, except that now we're looking at total payout, as what the name suggests, right? We're not looking at a per share basis. Unlike dividends, we think about everyone would get paid $2 per share. But in this case, given the share repurchase means I will buy shares back from the existing shareholders, such that I have less outstanding shares in the market. And so which means I'm looking at a total payout. I'm looking at if you have an investor as an aggregate, right? Everyone sitting in the same room. I'm looking at you in total, looking at the aggregate. Here is the total amount I'm going to give you. Share repurchase, pay some of you. Dividends, pay some of you. I'm looking at the total, right? And the formula is, again, is very straightforward. Check your
Excuse me, Frank.
yes.
The share repurchase is a different scenario, say, compared to follow-on public offering, yeah? The companies may do.
That's right.
It is different.
Yeah, that's different. Let me open up the thing.
Wait, Frank, when you repurchase the shares, do you does the company pay above market price or exactly at market price?
Usually you would think that it will pay at a market price, but then it depends. I mean, put this way, it makes no sense if they pay lower than the market price, right? I mean, that would be a very bad strategy to try to attract people to buy. I mean, if you just pay the market price, below the market price, why would they sell it to you?
Yep.
I mean, that's just a signal to think about that your company doesn't worth that much. I mean, that would be yeah. So which means if you think about it, share repurchase, your company currently trading at 20, and say, I as a management, I'm not going to pay you more than $10. Then what's the signal that you send to the investors? You think, then people think, maybe your company doesn't worth that much. But speaking of that tells you. So usually, again, that's what we learn in practice, is that when people do share repurchase and share which called seasonal here, let me just write it out. Repurchase, seasonal equity offering. Yeah, see, repurchase. So these two, even though there are ways for you to change the number of outstanding shares, you buy the way how you sort of you pay back to your shareholders, but in real life, we use those two to send out signal, right? Why would company do a share repurchase?
You said it's to decrease the number of shares outstanding,
and
so that they have to pay, so that they pay less dividends.
Yes or
Maybe
no,
they
but
think their price is underpriced.
Exactly, because you think that you're trying to send out a signal to think about, geez, our company share is so attractive that I as a company want to buy back, right? We think that was undervalued. And seasonal equity offering is that I'm going to issue more shares at the moment. And why do people do that? Partly is because they want to fund more investment, right? But the other part, that also means that I'm going to dilute the existing existing shareholders holding. But the other main reason for them to do that is because they may think that at the moment my company share price is overvalued, right? Let's just think about here. I'm an internet company, right? My internet company, I don't have much asset. I have a few, I have a few IT people, and I have a few, brilliant minds, and I have a lot of good ideas. And for some reason, my company now trading at $1 billion per share. I don't know why, but I wake up, my share price is $1 billion. What do? Remember, $1 billion per share means nothing to a company because that's a secondary market, right? Because the people buy and sell of your shares got nothing to do with your company's cash balance, right? Your capital, because that's what people done in the market. If you have to cash it off, you have to offer additional shares, right? You have to offer additional new shares to capture the price that you observe in the market. Because the secondary transaction got nothing to do with what you have, right? That's what people believe. But after all, the equity market, trading shares, secondary market. It's like I'm buying and selling a secondhand Ferrari, but nothing to do with a Ferrari company, right? So which means that those two people are used to signal where repurchase means that shares undervalued. Seasonal equity offering is that what they're not going to say is overpriced, but that's what I believe. That's a cheaper way for you to raise additional capitals, right?
Yep. Yeah. Thanks, Frank. Understood.
Oh, good. All right, so move on to, you can rate, again, this is not a lecture, so you can rate the other relevant part for week 7. Now let's move on to week 8. So week 8 and week 9 is like we're combining everything together. So week 8, we talk about investment decision rules. Hopefully that's what Danny talked about, I forgot. Week 9 is capital budgeting.
Yep.
Yeah, correct me if I'm wrong, because I haven't taught this unit this year. So investment decision rules basically is to tell you how, what investment do you make based on number of rules, NPV, IRR, payback, discounted payback, a profitability index. And the list can go on, right? But the reason why we get this list in the first place is coming from a famous study in finance. People actually survey. People survey these managers and the financial managers. They ask you to say, what tools do you make to make up your mind? Why do you pick that project, not that one? Or people saying we use NPV, we use IRR. Some of them using payback, some of them using discounted payback, right? Some of them using profitability index. That's all fine. So you actually learn a few more tools than that. And there's I think there's EAA. What do you call? Was that effective annual? I don't actually remember what EAA stands for. Would you guys know what EAA stands for?
Effective annual rate.
See what I have EAA here, because some year I don't. Oh yeah, equivalent annual annuity.
Equivalent annual, yeah. Equivalent annual annuity.
Such a unintuitive name.
It's pretty much the cash flow formula.
Yeah. And then, but it's actually quite interesting with that formula. And let me just explain to you in a second. Let's go through the slide. Let's just share my slides again. So remember, this is my slide, so that may look different from Daniel's. So bear in mind. So, but again, the core is the same, right? There we go. what we have here is that MPV, how do you make up your mind to get MPV? Well, you accept the positive one, reject the negative one, and the higher the better, right? So MPV profile, again, that has to rely on you using Excel to draw that. So what MPV profile here gives you is to show you at different discount rate, what is your MPV? It's kind of like a, it's kind of like, you know, it's kind of like saying, well, I estimate our cost of capital to be 10%. I'm not very confident with that. Can you show me what is, you know, what would the MPV be if it's like best case scenario, 6%, worst case scenario, 14%. Tell me what the MPV is. And then you calculate 3 numbers. And then people go, since you now calculate 3 numbers, why don't you calculate 10 numbers, right? And then why don't you draw a graph, right? And that's where it comes, right? Draw a graph to say, okay, just make sure your boss is happy, right? Instead of just keep asking me that question, just I can you know, present a graph to you saying based on a projected cash flows. So we're not making any assumption on the cash flows here. We're making an assumption on what the interest rate is, right? So based on that, so based on different interest rate, what would be my MPV given the projected cash flows, right? Given that. And the intercept here at 14%, that tells you at that point, MPV is 0. So, and I think about 40% of managers using IRR. And the reason why I use using IRR, in fact, I use IRR in one of my research papers. Using IRR is actually not an unreasonable assumption. So I mean, what does IRR give you? I mean, what is IRR?
Internal rate of return. It a metric used that works in conjunction with the NPV.
Yes, make sure that your NPV, well, it's kind of like saying, the IRR is like saying, if I have to pay a price to buy something, the IRR means that my price equals to my future discounted cash flows. You know, the IRR is like the yield to maturity in bond study. It's the same thing. It's just one of them called yield to maturity in bond. Well, IRR here is an interest rate that makes my present value to be 0. And people figured out that number is easy because if my IRR is 14%, that means to my mind is that if my cost of capital is lower than 14%, I'll have a positive MPV, right? And that means that I'll accept it. If it's above 14%, I will reject it, right? And but that quick, you know, decision-making process has a drawback, 2 drawbacks. First of all, it doesn't tell you if it's positive, how positive it is, which means I know here is positive, but I don't know the magnitude of that, right? The second one is that you may not have an IRR, or the IRR may be misleading, right? Misleading is what we're gonna examine next. So here, 45%, yeah, 45% people using IR. That's, I remember that. So, I mean, payback here, let's quickly talk about payback since we look at it here. So payback is like not worrying about your time value of money, just thinking about if I pay $100 to fund the project, how long will I be able to pay it off? In this case, this example illustrates that, well, you will pay back in 2 years. But it also tells you the downside, because if you look at a particular example, you will say, I'm inclined to choose C, right? Because you have $500 in year 3. But if you base on your sort of the decision rule based on payback, then C is going to be ignored, or C is going to be viewed as likely as the others. And then it doesn't take account the dollar amount, the size of the investment, because that will also pay you back in 2 years. But why would you want to do that, right? It's only give you back $1. So,
Frank.
Yes.
What payback period do you decide? Like, what determines which payback period you decide? So why 2 years?
Oh, because in this example, remember payback period is defined by saying how many years, how long will the period be in order to recoup your initial investment. In this case, if you pay $100 to establish the investment, you get 50 in year 1, 15 in year 2. That means by the end of year 2, you recoup your initial investment. That's why payback period is 2 years.
Is this working capital, Frank? If it's
nothing to do with working capital. This payback period here is just saying, based on the projected cash flows, how long would that take for me to recoup my initial investment?
No,
I mean,
when
sorry.
a business says if the project takes longer than X years, reject it. What determines X?
I mean, what determines X is very subjective. Sorry, it's very subjective. It's based on what company's view is. Well, and put this way, a typical rule of thumb is that it's based on how long you will be behind it. So let's say if some project would take 10 years for you to recoup the initial investment, and you only work for the company for 5 years, you don't care about that, because you want to be recouped during your term of the CEO, right?
Oh, right.
So I mean that's not scientific enough, but people come out with just like they come out with an idea. They say, I like number 3, so let's say 3 years. There isn't any science behind it. So
it's just an arbitrary number, pretty much.
It is an arbitrary number. So but people use it. I mean, people use it for very obvious reasons. It's like everyone does that in a mental accounting. It's like, let's say if someone to say, Frank, do you want to open a shop? They say, all right, fine. Oh, well, it's gonna cost you, say, I don't know, $1,000 to set it up. It costs you $1,000 to set it up, and roughly you will get paid like $20 every day. I said, wow, that's actually a good business, because by day 5, I already recovered my initial investment. So the remaining is all going to be profit. That's why you do that in your head, right? So that's why we have this rule.
So the best thing to do would just be to compare the different payback periods.
Well, the best thing is to avoid it. I mean, the best thing is that, I mean, again, the reason why we discuss this is because people actually use it. And then we want to talk about, people actually surveyed real managers to ask you, what do you use? They say about 1/5 of Fortune 1000 use it. And then, but you see that that's not the best tool after all, right? It's not bad, because it doesn't take account time value of money. It doesn't take into account the size of investment. It doesn't take into account your cash flows after you pay back, right? But we just explain to you what they are, right?
So
can you go back? Sorry.
No, go.
No, please go, Lorenzo, as you would.
All right, fine. So the better thing to do would be to use the different rules in conjunction with each other.
The best rule is to use NPV.
NPV, all right.
Yeah.
So the general consensus, Frank, in the digital age we live in, the main rules are use NPV and IRR. Is that correct? They work in conjunction with one another. Yeah.
Well, I mean, the actual answer to that question is that the best way is to use whatever that you can use, if that makes sense. So which means that, of course,
that's what Daniel applied to us, that being NPV, IRR, for the grand scheme of things, are the main preference, as it were, in general, for when pricing projects and what have you, and getting costing or whatever. Yeah.
That's right. I mean, because after all, IRR give you a number, right? But NPV is what gives you the magnitude. And then if they have different lives, if you're comparing projects with unequal lives, you want to use EAA. Oh, I just realized my iPad is not charging. But anyway, that's fine. I've got 38% on my. Hopefully, it runs for another, I don't know, 40 minutes or an hour. So the payback period. Well, you learn about IRR, but there are drawbacks with IRR. I mean, you guys, if you read the lecture, you will know that, because if you have, so let's say if you have delayed investment and your IRR is going to be, your IRR is going to be weird. So what's going on over here is, think about, let's just say, typically, my project looks like I have to pay something first, and then I'll get my investment back later, right? But what if you're on the other side of the transaction? So which means, think about coupon paying bond, right? You know, I pay bond price and then I get coupon payment. But then there will be someone else on the other side who will sell me the bond and pay me back coupons, right? And that means for him, the IRR decision rule is the opposite. Because for me, the lower the interest rate, the higher the NPV. But for him, it's the opposite because it's a zero-sum game, right? So which means that in this case, what if you think about this? What if you're on the other side of transaction? What if you receive 1 million first and then you pay back 0.5, 0.5, 0.5? And that means in this case, although your IRR is arrived at the same number as the other party, but your interpretation needs to be flipped around. It's the opposite. I know it's kind of like confusing, and maybe Daniel didn't even use that example, but that's how I think is that, well, when I'm making an investment, right? So let's say when I'm doing transaction, bond, I swap the bond with you, you know, I trade against you, right? And that means to me, if low interest rate is better, that just means low interest rate is worse to you. If high interest rate is better for me, that means high interest rate is worse for you. Right. That's what, so which means if you think about this graph over here, right, where the lower the interest rate, the higher the NPV, the higher the interest rate, the lower the NPV. That means if this is a transaction between two parties, that's the opposite for the other party, right? Yep. That means if it's more profit to you, that means there are more loss to the other person. So which means the IRR rule only applies to what you call the conventional way, which is I made an investment and I get paid my cash flow back later, right? So that's what I was trying to explain over here. Is what if you are on the other side of the party, right? That's what I'm saying. Delayed investment, you get the opposite way, right? So again, the best way, draw the NPV profile to look at why that's upside down, why that's the other way, because you're now on the other side of the transaction, right? And of course, you can also have a non-existent IRR. So what you mean by non-existent IRR, it just means, for example, you take a look at this slide. Do you have an IRR? Well, I don't think any IRR will give you an NPV of 0 because there's no initial investment. But would you reject it? No, you would be stupid to reject it because it's like free lunch. Why not? Why don't you take it, right? Because if someone's saying, I'm gonna give you 500 grand every year, you would say, hang on a second, the IR doesn't exist, I'll reject it. But that's stupid, right? So in this case, so I mean, that just illustrates the IRR may not exist. So which means that if IRR is your benchmark, you don't have a benchmark to compare with because it doesn't exist. Right? Mathematically, it doesn't exist in this case.
Wouldn't that be an arbitrage opportunity then?
I mean, exactly. That will be. I mean, that's more than arbitrage. That's free lunch. That's really just free lunch. I mean, really, it's just trying to illustrate that that's the case, right? That's the case. So which means that there will be some scenario where you just don't have an IRR. You can't calculate an IRR, right? Doesn't matter what you do, you're gonna get a positive payoff, right? Just like I don't know, just like National Australia Bank offering you a scholarship, and are you gonna calculate your IRR in that way? Probably not, because it's gonna be free money to you, right? You just need to figure out whether how you should spend it. And then you can also have multiple IRRs, which means you can have more than one. And the rule in general here again, draw the NPV profile. You can work out why you have multiple IRRs. But I don't think Daniel talked about it. He may or may not be. But multiple IRRs just means that I can look it up in my cash flows. I can look at my cash flow signs. So which means if I have a conventional cash flow stream, means I invest times 0 and I get payback plus. That means mathematically I have one IRR. But if I have two changes, so which means initially as a minus and then becomes a positive, and stay positive. And then I have another sign change here, sign change from plus to minus. Then that means potentially I have two IRs. This is just rules of math, right? They may not be real numbers, could be imaginary numbers, but it just means you have multiple IRs. So here I have 4 changes, 1, 2, 3, and 4, right? From minus to plus, 1 change, plus to minus, 2 change, minus to plus, 3 changes, and then plus to minus again, 4 changes. So that just means potentially I have 4 IRs. It doesn't mean you can actually find 4 IRRs of real numbers, but just means that you do. So again, that just brings the complication of like, you can't use IRR as a rule, right? Because that.
Hey, Frank.
Yeah.
Have you heard of projects that have been costed using the multiple IR rule before? Are there many out there that get costed that way, or? It
is possible. I mean, I can think that you can think about. You can just think about any scenario, right? In year 2, you require a big maintenance cost. And towards the end, you have to pay it off because you have to clean up the site, right? So it is possible, very possible.
Okay.
Yeah, I mean, but we tend to think of everything as this. We tend to think of everything like, but it doesn't happen to be that way, right? And that shows you why we don't use IR, right? And then think about this. If you have a mutually exclusive, pick the highest MPV. And so on and so on. And the other reason, so here we have an incremental IR. So the incremental IR is like I have 2 projects. I can make up my mind to think about, should I choose A? Should I choose B? By doing A minus B and looking at the IRR of the project of A minus B, right? And and in fact, I've got a question. Good. Can I explain the expansion project and replacement project? In what can you actually? Do you mind elaborate what do you mean by expansion project and replacement project? Jingqiu?
I'm a little confused. Yes, I'm a little confused about the function when doing the problems.
So what is expansion project?
That is when you will decide to make an investment to buy an equipment. So what's the cash flow? Initial outlay, the cash flow year 1 to year end, and then the cash flow in the at the end of the year, something like that.
Well, I mean, there really isn't any major difference between any of that. It's just, so after all, you're comparing with 1 or 2 or 3 things, right? 2 or 3 things. So after all, your mind should be going, which one would give you higher MPV? So it doesn't really matter what you do, right? Your ultimate goal is to say, whether it's going to be expanding or you're going to replace with the existing project, is to think about which one will give you higher MPV, right? Which one will give you higher MPV? And
no, actually, I'm confused. Is the cash flow during the 2 different projects, incremental investment, something like that.
Oh yeah, all right.
The cash flow thing.
Yeah, then that makes my explanation easier, because then I can actually point out to you. So what I'm showing you at the moment, some of you probably already know, given that you check your email over the weekend, is that if you go to our discussion forum, I've got about 4 questions I haven't answered yet. But if you go over there, if you can even search incremental IR. I think I wrote a thread on it. Yeah. So if you search for incremental IR in the search function, it will take you to a thread I wrote. So, because we have limited time today, because I've got other weeks of stuff to talk about. And if you want to learn a bit more about incremental IR, please read it here, because I wrote something about it, right? About the incremental IR, right? Please go ahead just to check that thread. If it is in forum 1, and if it should be able to find it on each pages. And then Jiaxing asking this question, if we know the shape of the graph for multiple IRRs, either up and then going up or down, or going down and up, technically we can still use the IRR rule. Is that, and well, if you draw an NPV profile tells you roughly what NPVs you will get at different rate. So which means that is no longer a simple just IRR rule, right? Because it tells you what your NPV is. So to answering that question, it is actually more like an NPV rule than an IRR rule. Yeah. So it is yeah, because NPV profile are always drawing out what NPV will be across different levels of interest rate. So it's you can think about it's combining the knowledge of NPV and IRR, but more on the NPV side because it tells you the magnitude of NPV at different rate.
So in the case of an investment that has two IRRs, the optimal decision would be to choose the investment where the interest rate is provides the maximum NPV.
Exactly.
If it's positive, or the lowest NPV if it's negative. The lowest minimum NPV if it's negative.
Yeah, well, I mean that is still maximizing it because you're still choosing the bigger number, right? The bigger of the two, right? I mean even its cost, you are still choosing the less negative one, which is still the higher one.
Yeah.
Yeah. Perfect. So let me think of, is there anything else I can talk about in week A?
But any interest rate where it's positive would still be okay.
Yeah. Yeah.
But you would choose where it's maximum.
Yeah. Yeah. You would choose. Yeah.
Okay.
So that's the IR rule, and that's a fancy graph. And the next one I want to talk about is equivalent annual annuity. So in fact, that one is probably I mean not many textbooks actually cover that. In fact, I think our book does cover that. So what's going on over here with EAA is saying, let's just imagine I have two projects. Project A goes for 100 years and give you NPV of saying $1 million. Project B goes for 2 years and give you an NPV of $990,000. And then you will go, okay, based on NPV rule, I would choose A. But if you have the right mind, you say, well, choose A, it would take 100 years to give you NPV of $1 million. But B will give me $990,000 for 2 years. Of course, I want to choose B, but how can I come up with a formal way to say I should choose B? In this case, EAA is the one I'm doing that. So what EAA is doing here is that, I mean, the formula is right in front of you, is NPV divided by the annuity factor, right? But what I is saying here is that he assumes that you can run this project forever, which means, let's just actually gonna use an example of what I have over here. Let's just say here, I'm dealing with two cases, A and B, right? I mean, trying to minimize the cost. What I want is doing over here is that, well, I'm assuming by the time I finish in year 3, I can replace A with another A. And in 6 years' time, when my second A finishes, I can replace my A with another A, which then runs for 3 years. And such that if it can be run and replaced forever, then both A and B becomes a perpetuity. If they become a perpetuity, the unequal life doesn't matter anymore, because loosely speaking, an infinity is equal to another infinity, right? So that's what's the idea behind. So which means here is my NPV divided by the new, actually, even better. I think someone just asked that question. Oh, there we go. Someone actually asked that in forum 1, project with different lives, right? So as you can see, you can ask any question online. So if you read about it, is that, well, we are doing this by dividing the NPV by the annuity factor. such that EAA is like the equivalent annual cash flow. Equivalent annual cash flow over 3 years. And then what you do here is that, and then what you do here is this part. And then what you do over here is that, well, I can calculate my EAA. Because if I rearrange it, that means EAA just means I will get that cash flow per year for 3 years to give me the same NPVA. After I do that, I can compare that number with EAB. Even though I assume this one go on forever, that means if you want to calculate the present value of a perpetuity, you divide EAA of A by R. I just realized that writing is so small. I may as well just draw it.
Is this an index or is this the actual cash flow per?
It's not the actual cash flow. So let's just say here, let me just illustrate it to you. So let's just say here, my cash flow is this. Right? Just say, imagine, here's my cash flows, right? Is this an annuity? No, this isn't an annuity, right? The reason why it's not an annuity because what is the annuity look like? The annuity looks like requires you to be 0 at the start, same amount of dollar every year, right? So which means I'm just assuming here, if this is annuity, will give me the same thing as the actual MPV, right? So which means I translate that one into this one, into this form, right? I translate what I have in cash flows into this form and such that I can calculate, and this is known as EAA, right? Equivalent annual annuity, A. And because now I assume that I can replace that project forever, I can then calculate the actual MPV if that is like a perpetuity, right? And then I can compare that with EA of B. But the reason why I don't do this is because mathematically, if EAA is bigger than that, EA divided by R is bigger than that. Then I don't have to do that, right? That's redundant. But that's a very important assumption of what's happening behind EAA. Because your question starts with, I'm comparing two projects with unequal lives. How do I convert them into equal lives? The way you convert them to equal life is to convert them into a perpetuity. So which means I can buy these and replace it, buy these and replace it, buy these and replace it, and forever, right? And then that could both become a perpetuity. But how do I calculate the present value of perpetuity? Is that I can think of a number that will give me the same MPV as what I have over there, right? I can figure out a number that's equal such that it will give me the same MPV as that. That's what's behind the EAA calculation, right? And then we can calculate EA, compare EA directly, not because that's the right way. That's because we don't have to divide it by R. Because the mass property, as long as R is bigger than 0, EAA divided by anything is bigger than EA divided by anything, as long as EA is bigger than EAB, right? So we just say, if that's bigger, take that. We don't have to divide it by. It's because it's redundant, right? But we do need to know we need to do that because in our mind, they are both going on forever, perpetuity, right? They're both going on forever. All right. So does that make sense? All right, good. So
excuse me, Frank.
Yes.
This EAR you mentioned here, is that the same EAR that coincides with the APR interest rate? You change from APR.
No, that's nothing to do with the interest rate.
Yeah, totally different.
So that's not the interest rate. So this one, this EAA here is like, here's my cash flows. Here's my cash flows. What will be an equivalent annual annuities such that they have the same MPV, such that those two have the same MPV? All right. So that's last bit for that week. And yeah, I mean, by the way, please utilize discussion forum, right? As you can see, I really do answer any kind of questions. So move on to week. Well, back in 2018, we have 13 weeks of lectures. Interesting. So capital budgeting, this is where I think Daniel's slide is quite different from mine. But capital budgeting is one that if you're not sure, you should definitely rewatch the lecture. If you're not sure. So I think back then I had an extra example. So if you go to your discussion forum, edit your page number, sorry. Still loading. I share something quite interesting as long as it's loaded. So if you go to discussion forum 01, questions related to lecture materials, if you scroll down, eventually you will see that there is another capital budgeting example step by step. So go to that one and you will be able to see I have another example to show you, and then I don't know why the internet is so slow. So just go ahead and open up that one, and I will show you step by step how to do a question, right? So here's a question, and I can just break it down and just show you where that goes, and show you what that means, right? And then if you're not sure, ask a question, and yeah, feel free to always ask a question, right?
Week 9 capital, is it?
Yeah, week 9. And because that's pretty much all you need to know for capital budgeting, is that it's just to figure out how you identify cash flows. And to identify cash flows, it's really just a single formula. It's just those formulas that is the free cash flow every year is roughly equals to revenue minus cost minus depreciation times 1 minus tax rate plus depreciation. And if you have capital expenditure in that year, which means if you buy a machine minus machine cost in that year, if you don't, that's 0. And then here minus the change in net working capital, right? Minus the change in net working capital. You're not adding it, you remove it, because that just means if I have an increase in my need for net working capital, I need to put more cash to it. I need to reduce the free cash flows because my cash is floated somewhere else, right? So
okay, so unlevered net income is the same as incremental earnings, is it?
Yes.
Okay, I love it. All right. Yeah,
yes.
Right. Cheers.
And in fact, you know, I like that because sometimes I remember where things are. Sometimes I don't, but so this is Forum 03 related to My Finance Lab. So on one of them, there is a question really saying MFL test EBIT. So in this example, I took the chance to illustrate the difference of all these different terms. So let's say if you're never sure of the difference between EBIT and EBITDA on unlevered net income and cash flows. So that thread explains to you using the numbers that you have here, and what this comes up. So EBIT means earnings before interest and tax, no tax. So you can see compare, you don't have a tax part to that. EBITDA just means earnings before interest, tax, depreciation, and amortization. That means here is just revenue minus cost. So that means if the question gives you the EBITDA is $5 million, that means it's revenue minus cost is $5 million, right? And if the question gives you the EBIT is $5 million, that means it's revenue minus cost minus depreciation is $5 million, right? So so Forum 03 frank L important, EBIT versus EBITDA versus unlevered net income versus FCF is an important one, in my opinion, right? It's important one that illustrates what these terms are in terms of revenue and cost and depreciation, right? All right, so that, I mean, I wanted to say that's it for week 9, but because week 9 really requires you to sit down, looking at a question and see whether you can do it, right? See whether you can do it. And if we take a look of, I'm just so tempting to open a document for an exam document. So week 9 has a higher percentage than week 8. So it's 19%. So about 1/5 of your exam come from week 9. I mean, come from chapter 9 as well. That's week 9, or chapter 9.
That's capital budgeting, yeah.
Sorry?
That's capital budgeting.
Yeah, it's capital budgeting, what we talked about, which means that there will definitely be a question asking you, there will be at least one question asking you to say, what's the NPV of the project? What are the free cash flows? And there are only a few things for you to think about: working capital, depreciation, and when you're selling the project, when you're selling the machine, what happens with the machine, and revenue and cost. There are not that many things to ask, right? So, but 19%. So then take us to week 10 and 11, which is chapters 11 and 12. Sorry about the gap in 10 because 10 is extension on 7. We don't cover that, right? So 11 and 12. My personal advice really is to stick with your lecture notes, right? You can read textbook for sure, not a problem, but I would say stick with your lecture notes to have a solid understanding of that. I don't think I have a version of Daniel's lecture note. So, but week 11, I mean, sorry, lecture. This is actually lecture 10, right? Because back then they have different names. So it's talking about risk and return. So this is chapter 11, risk and return. So risk and return here, there are a few things that you definitely need to know. Is that how do I calculate return, right? How do I calculate return, expected return? How do I calculate variance, standard deviation, right? Knowing how to do that. But in practice, we teach you this is because, I mean, let me give you a quick overview of that week. The purpose of teaching you risk and return is to tell you one of the most important things in finance is that we're trying to establish a relationship between risk and return. Because we're trying to say, well, high risk, high return, right? But we don't know exactly for sure high risk will guarantee you to have high return. Because let's just say, if you go rob a bank these days, it's very risky, but the bank doesn't have much cash there, right? So it's high risk event but low return. So which means that how can I actually prove it that is high risk, high return, low risk, low return? And that's essentially what this week about. Right, so you learn all this expected return and variance. It's just really to get you to understand what's behind it. So over here, if you look at it, is that let me just go over here. So this again is an important slide. So what that slide is saying here is that excuse me, is that based on what we observe, this is potential range of your outcome. This one is saying roughly a lot of the observations give you a yearly 0% return. Roughly, you have some observations that falling around 2%, some falling around 3%. No extremes on either tail for the top one, right? For the top one. For the second one, you can see that now the distribution are wider, where some are falling around 0%, but there are some more falling down to 20% range. That means every year they will give you 20% return. Some observations. And let's go to the last one. The last one is going from every year, some years will give you minus 50%. Some years will give you more than 100%, right? Some years. So which means if you base on that, you think about it, well, which one is riskier? Top one is less risky than the others, right? Because this one just means that I know my outcomes. Just think about your mismatch exam distribution, right? If everyone get 100%, that means everyone did well. Easy exam, right? But if I have a very wide range of distribution, that just means there are a lot of uncertainties. A lot of uncertainties about where, about exam level. I just say here, I want to guess, how did I perform? If I look at this distribution, I would say I'm roughly here because I'm an average person. I'll be wrong here. But if you look at that and say, I don't know, could be anywhere between that and that one. So that means here is a very wide dispersion, and that means it's high risk. And how do we measure dispersion in statistics? Variance, right? Variance and return. That tells you why we're using return and variance to measure return and risk in finance. And then you have all these formulas. So people ask me saying, some students ask me saying, do I need to know these formulas? I guess yes you do, but I don't know, it is there, right? If I were the exam writer, I wouldn't ask you questions about calculating variance because it's stupid, but it is there, right? So you probably do need to know it, right?
Can you explain why it's T-1?
Yeah, I'm glad you asked that because I actually explained it. So on the discussion forum, someone just asked a question just then, why discount share price? So let me have a look. Do I have that? Yes. So Lorenzo. So someone asked that question in forum 1. Realized variance, test 10, question 3.
Okay.
So if you go over there quickly and you see that I explained to you why it's 1 over t minus 1, not 1 over t.
It was to remove a degree of freedom, but I don't understand what this degree of freedom.
So degree of freedom here, it means that, well, I'm dealing with a sample. So which means, so in statistics, I have a sample, I have a population. So which means, let's just say, if I want to measure the average height of FINA1221 students, then ideally speaking, I'll get everyone to lie in front of me. I'm just gonna measure your height, right? But I can't do that. I can't even get, I don't know, I just can't do that, right? Because I'm not able to put everyone together. Some of people in China, some people in Singapore, some of you in Perth. But what I can do is that I sample it. Means I take 5 people from China, 5 people from Singapore, 20 people from Perth, and I just measure your height based on that sample, right? Is this sample representative of population? Probably not. I don't know. So which means that in this case, I don't know the sample average. I don't know the actual average of the population. So which means when I calculate variance, the sample variance, I lose a degree of freedom because I have to estimate the mean, such that your measure is not going to be biased. So to prove it, it actually requires a little bit more math to show you why that's unbiased. But that just means you can loosely think about that, because now I don't know the true mean. So which means when I calculate variance, that number is estimated. So which means I lose a degree of freedom to do it. So which means yeah, it's just I'm reiterating myself, but that's just what that means. It's just that that is an unbiased measure. So unbiased, I don't know how to explain unbiased in a simple way without showing formulas. But when you have larger enough sample, so what I want is saying here is that when I have large enough sample, t minus 1 is roughly the same as T, right? So which means if I have 5,000 people in my sample, it's not going to be different from 4,999, right? It's roughly, so number is going to be the same, but yeah, but over here, it just need to remember, right? That's 1 over T minus 1. But in fact, many people just using 1 over T anyway, right? It's like we accept it either way, really, we accept it either way.
I think I get it now.
All right, good. So what we keep going on is to then saying, well, we see the relationship for positive relationship between risk and return for portfolios, but we don't see that for individual stocks. How can we then show there is going to be a positive relationship for individual stocks? And then we invent a new term called beta, right? Let me share my screen. So when we say we have risk, we use that, we first of all use variance to approximate risk of volatility. So this means square root of variance. But then we realize that this one doesn't work for individual stocks, right? So for portfolio level, I have relationship for risk and return, right? Tick the box. But for individual stocks, my risk return does not have that relationship. That's empirically, right? Empirically, we don't have a relationship. So which means variance can no longer use to measure risk for individual stocks. What we then come up with an idea, again, that's just, we invented to think about, well, in that case, I think it's perfectly to say variance measures the total risk, because variance measures whatever can influence the share price, So we may be able to say what influences the share price can come from two sources. One is coming from the market, which is what you call systematic risk, which means whatever does has an impact to the market. That means, let's say if one of the countries under nuclear attack, that's going to happen to the entire country. So which means that every single stock in that country will be affected. In fact, every single stock in the whole world is going to be affected, right? Because we are not isolated. But then you can think about, well, we have a firm-specific risk. Firm-specific risk means is only specific to your firm, such as, for example, your CEO may conduct a crime that may be put in jail, such that you're gonna missing a key executives in the management team. But that's very specific to your company. That event got nothing to do with another company, right? So which means that in this case, it is reasonable for us to argue your risk can come from two ways, two sources: systematic and firm specific. And then what we're gonna say that week is that firm specific, because it's only specific to your firms, if I combine with another asset together, if I have two assets, then the chance of your firm specific risk happen to all my portfolio is smaller now. And if I combine another stock, that risk is getting even smaller. So which means what we're then trying to argue in that week is that systematic risk is the risk we use to measure the individual risk when it comes to the individual level. So which means in this case, I'm still able to find a positive relationship between risk and return, except my risk is no longer a total risk variance, is now what you call beta.
Beta, well, is only systematic risk, is it not?
Exactly. Beta is only systematic risk. And we're showing you don't get any reward for holding firm specific risk. holding this. And that also explains to you to think about why robbing a particular bank could be risky and low return, because that bank may happen to be no cash in it. You know, because there are many banks for you to rob, right? I'm not encouraging, you know, bank robbing. I'm just saying, if you randomly pick a bank, there's a good chance that one of the banks doesn't have cash in it, right? So like if you rob an ATM, there's a good chance the ATM doesn't have any cash in it. Someone just loaded, right? Someone just unloaded, right? So which means that in this case, that's a very specific to that particular ATM. I'm not saying robbing bank is not generally risky, sorry, not generally rewarding, but it's just that that particular bank just doesn't have cash in it, right? Which means which means we want to say is that higher risk, high return only applies to systematic for firm level, right? Firm level, and that's what essentially was covered in that week. And then what we're saying here is that, okay, let's derive the firm, let's derive the CAPM formula. So what CAPM formula here is saying, well, we're saying, what's the expected return of the asset? I think, first of all, I'm going to be benchmarked against risk-free rate, because the firm has to generate more return than risk-free, because risk-free asset is risk-free, it's zero risk. If you don't generate more return than risk-free, then why do I buy it? Well, I'm just going to go with risk-free. Plus, here, this is my, what do you call that? Risk level times return per risk. So, I mean, this is how we derive CAPM formula in week 10, right? In chapter 11, week 10. So what I'm saying here is that my return can be seen as benchmarking against with risk rate plus here, because I'm holding risk, right? And this risk is sort of benchmarking against market, right? Benchmarking against the market. So which means if I'm as risky as the market, my beta is going to be 1, right? Let me write it here. If I am as risky as market, beta equals to 1, then my ERI equals to RF plus 1 times ERM minus IF equals to ERM. Which makes sense, because if I'm as risky as the asset, as the market, I should get the same return as the market. So which means if you think about this formula over here, is that this is like the risk level I'm taking. This is the return per risk level I'm taking. So which means if I'm taking 2 units of risk, then I should get 2 times the return per risk, right? 2 times that. And that's how you interpret in that way, in that week. So in the risk and return week, we derive the CAPM formula from this idea of using beta to measure the risk level. Market return, excess market return, market minus risk rate as the return per risk. Because we think market is the systematic, right? If you're holding the market, then you're not holding any firm specific risk, right? So which means if I hold a market, I'm only holding total risk, and total risk is 100% firm specific. Sorry, systematic, right? 100% systematic. So that's how you derive that. And then in week 11, which is what we just talked about in the lecture recording, is another way to arrive at the same formula, but now coming from a portfolio approach, right? It's coming from a portfolio approach. Yeah, I mean, there are a lot of formulas in this particular one, but I just wanted to say that the idea is very simple. Is that we talk about holding portfolios will reduce the firm specific risk. But how do you actually do that? How do you achieve it? So now you're having portfolio, then we should know how to calculate portfolio return, right? Calculate portfolio return, calculate portfolio variance, and do all that, right? And then essentially what we're going to show over here, what we are showing over here is that the way how you reduce your portfolio variance, the way how you can maximize the benefit of holding portfolio is to figure out, I want to diversify across asset class. So in this particular example, I have North Air, airline company, and an oil company. And I realized that if I'm holding a air company and oil company, even though they give me the same return, but I actually have lower volatility, right? So which means that, well, you can't just close your eyes to say, I'm just gonna randomly pick a portfolio. Because here, doesn't matter what investment you make, but one of them is gonna give you a lower volatility, which means that one is gonna be better than that. If you are if you're risk averse, right? Risk averse, because I hate risk in this case. And yeah, again, we have to introduce formulas to show you how you calculate that. Covariance, correlation, matches. Correlation just describe the relationship of two assets, right? Describe it. So, but all that is trying to come down to this point where now imagine I have two stocks in my portfolio. And that's the only two stocks available in the whole market. Only two stocks. There is nothing else. There's only Intel and Coca-Cola, right? Let's say if I only have Intel and Coca-Cola for me to invest, then I can just construct this to think about, all right, what is the return of my portfolio if I'm holding 100% Intel, 0% Coca-Cola, vice versa. And I can construct this, and I realize that if this is return, this is volatility. And I realize that, well, this part is superior than that part because I prefer to have high return at the same volatility. So that means this is redundant. And what that then shows here is that, okay, what if there's a third asset in the market? If there's a third asset in the market, is where you can think about, if I have a third asset in the market, let's say called Ball. Looks like Ball is worse than Coca-Cola. Looks like it. There's lower return, but same volatility. But remember, this volatility doesn't measure risk. Beta is the one measuring risk for individual stocks. But let's say if I have a third one, what I want to show here is that it will ultimately push my efficient frontier northwest. That means having more asset for me to invest in to construct a portfolio will help me push my boundary leftwards. And that's what preferred because that will give me higher return for the same amount of risk. And if you're adding 10 stocks, 25 stocks, you can think about that's just going to be push this even further. Push this even further. So eventually, imagine we have all the stocks in the market. We're able to construct this. So in this unit, we're not going to get into constructors. You're going to do that in another unit, FINA1221 or 07 or like the other unit, right? But in this unit, we just show you roughly this is the graph. Roughly this is the graph. And now we introduce a risk-free asset. The reason why we introduce risk-free asset is for two reasons. It's because risk-free asset has two very important characteristics. First of all, zero risk. So which means risk-free asset itself has no risk. Second of all, risk-free asset has no covariance with anything else because it's just by itself, doesn't move. And that means in this case, if I do that, I'm able to write my variance. My variance of the volatility of my portfolio is now becomes a fraction of my original portfolio. So that helps you to extend your graph from just this point to this point. So now combine it with risk-free asset. Combine with risk-free asset. But then this one tells you the reason why you don't pick this one is because you can do better by choosing that. Because that one gives you high return. So which means you will just change the angle of the line such that until at a point that you just tangent to this curve, not above it, because you can't do that above it. Because it doesn't, let's say, what if someone's saying, I want to do this? Is that possible? Impossible, right? Because we don't have enough asset to do that, right? But what we can do is here, we move this line, start that until it touches that point, and that point is what we call a tangent portfolio, and that portfolio is the market portfolio. That's the market portfolio. And then we argue that because everyone has watched Frank's lecture, everyone knows this. So which means, let's say if I ask you, let's say if that's the right way to do it, would you choose this line? Would you choose this line? No, you will pick that line, right? If I ask him, he said, would you choose that line? No, I will pick that line. So which means, let's just say, assuming, remember this is the model. This is a model. Assuming everyone knows this knowledge, then no one will pick anything else other than the green line. And so that means this green line here means that is the market portfolio because everyone is holding it. Less like everyone is holding some proportion of that because it depends on some people may say, I allocate 10% to risk rate, rest into the market. Someone say, I'll invest here, I'll invest here, I'll invest here. So which means that everyone's portfolio is just having to be on that line. Depends on your preference towards how much you want to borrow or how much you want to put in the risk rate. But everyone is holding a fraction of the market portfolio, right? Everyone is holding a proportion of the market portfolio. So that and then what we then derive here is that if you think about this, if you think about when I'm trying to buy a new asset, I will require additional return on the asset. That has to be greater than the incremental volatility from investment line, which is coming from another slide, times return per unit of volatility. So which means in this case, what I'm trying to do over here is to think about my decision to add a new asset to my class is to think about what is the additional risk it will generate, multiply by what is the return per unit for that risk. And where do I get at? That is just slope, right? So let's just say if I want to make up my mind, if I want to include that one into my asset, here, does that actually going to decrease that or increase it? Does it actually going to provide me more payoffs? Which means that is it going to lower the line or sort of like flatten the line, right? Flatten the line or steepen the line. So what? So that is. Oops. What do I press? N.
So Frank, so as long as you're touching that tangent line, that's risk-free, huh?
As long as you touch the tangent line, that means your portfolio involves some proportion of the risk-free asset and the market portfolio.
Okay.
Yeah. So here.
So by definition, it's not 100%, but next to, yeah?
Say again?
100%. By definition, it's not 100% risk-free, but next to, yes?
Sorry, let me. Yeah. If you are 100% risk-free, that's here. If you're 100% in market, that's there. Because that tangent line means you touch that frontier. And that just means that can be achieved without risk-free asset. Remember, every point on that line is what's constructed by the underlying portfolio. It's like a different combination of weight, right? So which means that this is the only line on that one that is what can be available without a risk-free asset. I mean, of course, all this point on this line is achieved without the help of risk-free asset. But only this line is the one that can be achieved without the risk-free asset and with only just this, and also preferred than everything else, right? And that's what we call tangent portfolio. And at that point, 100% in market portfolio. At that point, 100% in risk-free asset. Everything in between is a combination, right? The combination of saying maybe here 10% of risk-free, here 110% risk in market, and I borrow 10% to fund that, right? That's just like, so that's what's going on here. So if you think about the slope of this line, the slope is defined to be rise over run, right? Rise over, so that's the slope. Rise over run means this: rise, which is P minus the risk rate. What's the run? Volatility. And that explains to you what that here is. This is the slope of the line. So which means the slope of the line tells you what is your return per unit of risk. And this one tells you, if I buy another asset, this is the incremental volatility from that investment, right? This is the incremental volatility from that investment multiplied by here, my portfolio tells you, if I want to have another return, I need to take additional risk. And that is the return per unit risk. So which means that my idea is that if I want to buy another asset, it has to be greater than that. And guess what? And then we just figure out, oh, that looks fancy. Why don't we just call this rate, this SD correlation, SD, we call that rate beta. And then we can simplify into that next line. And that becomes this. So which means we arrive at the same answer as week 10, but now we come from a different approach because here we're constructing portfolios. Is what I'm saying here is that, well, if I want to buy another asset, if I want to include another asset into my portfolio, it has to meet these criteria that the return it generates has to be greater than the unit per risk times the additional volatility, additional risk times the return per risk, right? It has to be greater than that. And then the next line is just a rewriting that such that it makes it easier to look. It makes it easier to look for lattice beta. And then we arrive at the same answer as the capital asset pricing model. But as you can see, the actual calculation question of this week is very straightforward. You know, we give you the beta here. We give you the standard deviation, correlation, and standard deviation. Calculate the beta. We give you risk-free rate. We give you the market return. Calculate the ERI. Right? It's the actual calculation-wise is very straightforward. And one thing people normally forget about is let me just write it on my iPad, because that's a common mistake people make.
Frank, we can't see it.
Yeah, I am trying to synchronize it. Can you see it now?
Yeah, all good.
All right. So here's the CAPM formula, right? It's the CAPM formula, ERF. And this is market return. And I'm going to highlight it in green. Oops. And this is market, bad idea, using red. Market risk premium is this. So what's inside the ERM is the market return. The whole thing in the bracket is market risk premium. Right, that's one concept people usually confuse about, saying, I give you the market risk premium, 5%, they think 5% is this. No, market risk premium is this two terms. Because risk premium means is a premium, is excess of something, which means that it's excess of the risk-free rate. That's what a premium is. Market return is just the return number. Market risk premium is the ERM minus IM, right? That's like such a common mistake people usually make. And then, yeah, I mean, if you can do week 11 test, you should be fine and understand the idea behind it. You should be fine as well. Let me check. But that's pretty much sorry, that's pretty much what I have in terms of the sort of like summary of the weeks 11 to week 6 to week 11, right? We've gone 21 minutes past the time, and thanks for being here. Any questions?
Thank you, Frank. That was very insightful. I'll probably ask you a few more questions via
forum. And
the forum.
I have two other consultations online. I can't remember the time, but it's gonna be, I think it's available on our mass, right? It's the one that's on Zoom, that will be me, right? If it's gonna Zoom details, it'll be me. I'm happy to go there, answer questions, right? But otherwise, really good luck, and really enjoy the exam. The exam will be easier, right? Although I can't say that it's very objectively, but in my opinion, really, it is a lot easier than the mismatch exam.
I look forward to it.
All right, good.
Thanks, Frank.
Thanks, guys, for coming up. And yeah, all good. Thank you.
Cheers, guys. Pleasure. Thank you.
No worries. Good to spend time together on Sunday.
Thanks, Frank.
Sunday afternoon. Yeah.
So the exam only covers 6 to 11.
Correct.
Okay.
All right.
So 1 to 5 is not covered explicitly.
Not explicitly, but I don't know. I mean, let's say we cannot not give you an interest rate. So let's say 5 is an interest rate. Would you say that is covered from week 1 to 5? Yes, because you need to calculate NPV for capital budgeting, right? So you do need to know some of that, but we're not going to ask you specifically to say what's the nominal rate if the inflation is the real interest rate is. We're not going to ask you that. Okay. That's very specific to week 5.
Okay, so explicitly week 6 to 11, and we just need to know the fundamentals for weeks 1 to 5.
Correct.
All right, all good.
And
thanks, Frank.
Definitely nothing coming from week 2 about what is the I don't know, like what is the the week 2 stuff, right?
Company theory or stuff like that.
Yeah, so we're not going to ask you anything explicitly about week 1 to 5. We're trying to isolate the concept as much as we can. Trying our best, really.
Okay.
All right.
Thanks, Frank.
Sorry, may I ask, in the short answer questions, do we only have the practical questions, or we also have the questions about the concept?
It depends. I don't know. If that answers, I do know, but I would say just it's gonna be mainly qualitative, but there may be some question require you to calculate just like one step, but it's all about your understanding of the concept.
Thanks.
No worries.
Thank you. See you.
Right. Good luck, guys, and I'll see you guys soon.
Cheers, Frank. Thank you.
One more question about the short answers. What do you expect us to write in a short answer?
Write what you believe is right to write. So I don't know, write anything that will help you gain marks. Do not leave it as blank. If you leave it as blank, there's nothing we can moderate.
Okay.
Yeah, you should give us some room to play with.
I mean, like, how do we answer the question?
I don't know, answer the question directly. For example, the mismatch exam, there's a question asking you saying, you have a friend, was it Tom and Jerry, right? Tom and Jerry. Yeah, question asks, is Jerry correct? A lot of people just go, a lot of people go, Tom is wrong. We're not asking you about Tom. Tom is simply asking you for help. I don't know why you think Tom is wrong. So, to answer the question. So, I don't know. So if the question asks you saying, is Jerry correct? Start with the question saying Jerry is not correct. Jerry is correct. And then explain why, right?
The reason as to why Jerry's not correct.
Well, Jerry is incorrect. That's right. Jerry is incorrect. Because you can't compare cash flows at different point in time together. He was saying the car will cost you $15,000, but in fact that is not. The car would only cost you $10,000. That's it, right? Cost you $10,000 today. That's how much it costs. That's a fact. Yeah. Okay. No worries. But the general advice is that the more you write, the higher chance you get higher mark. The more you write, but writing more can also reveal that you don't understand the question. So sometimes you read it as saying, well, you actually don't know it. So, but writing something is better than writing nothing. Yeah.
Okay.
Cheers, Frank.
All right,
Just
bye,
put,
guys.
just whatever you think is necessary.
Yeah, whatever you think is necessary. Yeah.
Okay. All right.
Hopefully we don't fail anyone, but I don't know. I mean, sorry, it's just before you guys go, just an interesting statistics. We have about 1/5 of people did 0 MFL test. So we have 540 people in the class. About a 20 student, 120 did not do any test. And while we have sent them reminding email, I've tried everything they can. I don't know why people don't do MFL test. It's 30%.
They didn't even do part of it. Didn't even do
part of it, and that's always the case every year. I don't know. I mean, how can I pass students? I don't know how to pass the student if you don't.
They're giving up 30% for free.
Yes.
Possible 30%. Yeah.
So I don't know. Everyone has different attitude. You know, that's I don't understand. And
how many people in this class, Rick?
I can't recognize the names, but then from the statistics.
No, how many people? How many people all up in this?
About 120 in total that don't do any tests. We have 550 students, and
550 students doing finance. Wow.
And then we have on average 440 students who complete each test. So yeah, it's always the case that some people don't do tests. No, I just don't understand why. Yeah, I don't understand. I mean, I really want to knock on the door to saying why don't you do it? But yeah, we reminded them. It's unfortunate. Yeah. All right. You know, I mean, we're trying to pass everyone this unit. If you do actually spend effort, you would know that this unit is very possible, right? But unfortunately, I don't know why some people choose not to pass it. Yeah. All right. Anyway, good luck.
Passing mark is 50, isn't it?
Yeah. Sorry. Yes, 50. Yeah.
50. Okay.
Yeah. It's so achievable. Yeah.
Okay.
Right.
Oh, wait, how much? Wait, did you just say how much it takes to pass the unit?
50.
Oh, 50%.
Yeah. So if you've done 30% in your MFL test, if you do well in your tutorial, 10%. If you already passed your mismatch exam, you may not want to turn up your final exam. I'm just saying, you don't have to pass the final exam to pass the exam. It's very possible. Yeah.
Okay. All right. Thanks, Frank.
Cheers, Frank. Thank you.
Cheers, Frank. Thanks for all the help.
Bye. Appreciate it, Frank.
Bye.